Good morning from our global headquarters in New York. I'm Menace Cranny. You're welcome to Bloomberg Brief. Let's set your agenda. Global equities stabilized for now. Japan leads the rebound, with the Nikkei jumping more than 10% after a tumultuous 24 hours. Still, investors question the scale of the carry trade unwind as Japan's top currency official says the BOJ, they're closely watching and monitoring markets. And Aramco keeps its quarterly dividend at $31 billion despite the lower profit as Saudi Arabia faces a budget deficit. Are you nervous? Do you trust this recovery? Mild as it is, we've come off the highs of the overnight, but there is a moment of stability here. Spoos gave back 3% yesterday, the biggest drop in 2 years. Goldilocks has been served some toxic porridge. The question is whether this is a 1987 style sell down or 2000, 2008. It is not. The consensus is landing on 1987, which was a 3-month, quite a dramatic drawdown in equity markets. The Nasdaq rallying by 0.7%. There will be no peace in these markets until dollar-yen stabilizes. 2-year yields, by the way, I want to give you some context. 2-year yields traded down to 364 yesterday, rebounding 396 this morning. That's a move higher at one juncture by 35 basis points. An inter-meeting cut frenzy that we had yesterday. State Street say this to me: you're crazy to think that the Fed would respond with an inter-meeting cut of 50 bips to a bunch of crowded, over-levered trades in FX, equity dispersion, vol premium harvesting, and AI FOMO. I show you the Asian session. This is where the yen has rallied by 4 big figures overnight. They are on intervention watch in the other direction. Mamura, the top currency official, says the government, the BOJ, are working closely together. The Nikkei managing to turn it around by 10% after tumbling more than 12% yesterday. So outpacing their Black Monday crash of 1987 and turning it around. Is the carry trade done? There's one man with the answer to that and some perspective to the Asian trade. Mark Cudmore joins me now, our Bloomberg macro strategist. Mark, good to see you. So the whip around in the equity market is there. Yen is ascending, and we are I would say we're on verbal intervention watch in the other direction. How much of the carry trade is unwound? Good morning.
Good morning. I think there's a large amount of it. I think there's basically 2 types of carry trade. There's the short-term kind of day trader, hedge fund carry trade. That carry trade has pretty much blown up. In fact, a lot of it was already taken off even going into the BOJ last week. The rest has kind of been cleaned out. Sure, there might be some lingering CTA positions out there that still need to be squeezed, but that's not the problematic carry trade. There is still a very large structural carry trade overhang of short yen positions that come from those kind of real money or those kind of structured notes or real estate developments. Many of those positions will be held in private assets. They'll be held by high net worth individuals. They'll be held in products that may not mark to market so regularly, and therefore the full kind of losses and extent may not be realized later on in the month. It may take a couple of weeks or months to be kind of to be taken out, if it indeed gets taken out. I think there's an important aspect. While there is still a massive structural overhang of long-term borrowing in yen to buy other assets around the world, it doesn't necessarily mean that it will get cleaned out just because the BOJ has hiked rates. I think a lot depends on what your global macro view is. Do you think the Fed really is going to cut rates aggressively? Do you think that the US is going to hard landing? If that's the case, then the dollar-yen trade probably continues, and that will probably squeeze through on the yen on the crosses as well. But there's another narrative out there that we're suddenly panicking about the US economy. We're suddenly panicking about a hard landing that no one was kind of anticipating only a few weeks ago, just because of a few weak prints. We're still adding jobs in the US. ISM still strong. So I think that perhaps the hard landing fears in the US are overdone. If that's the case, sure, we might have markets correct for another few weeks. I don't think the pain of this week, the last few days, is over. I think in the next few weeks, August, we'll see more markets pain. But there's a chance that by September, we're trading a different narrative again. BOJ has realized their mistake, and maybe we go back into a yen depreciation trade, and those long-term structural yen shorts never get cleaned out.
Okay, as you say, Mark, you know, the wonderful thing about the foreign exchange market is that it is OTC, and so understanding the size and the scale of that carry trade is somewhat like sticking your finger in the air until you get the data later in the week. Mark Cudmore on the latest overnight in Asia. Sharon Bell is the Senior Equity European Strategist at Goldman Sachs. Sharon, good morning, good to see you. If I go back 24 hours ago, there was a certain irrationality and panic to these markets. Friday growth scare, yesterday the Fed behind the curve. So do you, when you listen to Mark talking about the context of the carry trade, how much blame do you apportion to the unwinding of a carry trade to these quite aggressive panic-like moves in equities?
I think I would apportion a lot of the blame for the very large sell-off we saw in the indices in Japan to that move, because of course Japan equities are super correlated with the yen. The weakness of the yen was much of the reason for the strength of those equities in the last 12 months or so. So when you see that flip, then you do see this very, very aggressive move. So absolutely, I blame it for that. But I think it's not entirely driven by that. I think it's also driven by, the slightly weaker data we got out of the US, concerns, as you say, about recession, valuation of the US market. So it's not solely that carry trade.
No, it's not, but context really does matter. I know we say it every day when we go to commercial break, but it is about context, and this is what I want to understand from you. If I look at the post-COVID inflation scare, markets drew down by 23%, global financial crisis down by 56% over 17 months. But I go back to 1987, there was a 30% drawdown, and it was 3 months, and there was no recession. The context of this repricing, and I think that's what market participants and investors are trying to get their hands around. It's not whether the selling is done, it's whether the context of the floor has been put in. And I think we still have a ways to go before we reassess whether this drawdown is done. Would you agree with that? Is this looking more like 1987 than GFC? Yeah,
I mean, there are, of course, no perfect parallels historically, is there? But I think the GFC was a recession, and a global recession, and a very deep one, and we're certainly not looking for that. So I wouldn't see parallels with that. 1987, therefore, has slightly more parallels. But again, very, very different. I do think that it's not isolated to Japan, clearly, but the big fall was happening in Japan and was happening by this sort of crowded positioning. It's similar to 87 as well in that the market had done very, very well in the last 12 months. You take something like the NASDAQ, for example, was up 50% since October last year. Global equities up 30%. So that just always makes you more vulnerable.
Yeah, and I mean, even if you look back at SVB, I was on a call yesterday with a wealth manager, and he's saying, look back, man, I said SVB, the market was trading 3,800, 3,900, and you have had this massive uplift since then. He basically said, stop whining about 500 basis points. I think he's perhaps more of a veteran than I am. Let's talk about the framing of the narrative. Yesterday, there was quite a hysteria about a bane for the Fed to do an inter-meeting cut, and people were saying, this is what we need. I'm talking to Tim Graff this morning at State Street, and this is what he had to say. It's crazy to think that the Fed would respond with an intermeeting ease of 50 basis points because of a bunch of crowded, over-levered trades in FX carry, equity dispersion, vol premia, harvesting, and AI FOMO. I mean, I call that visceral, but how does the Fed frame the potential next move? Because the narrative is, if they go for 50, it really is panic and global growth scare vindicated. How do they frame the cut? And contextually, can you at Goldman see 50 basis points? I know it's part of your call. You see a recession, but how do they frame this cut, Sharon?
Yeah, look, I mean, I probably agree with most of that statement. I feel that the Fed is not there to sort of save particular positions if they go wrong. The Fed is there to consider inflation and economic growth in the US. Economic growth and the data has been more mixed more recently. That's for sure. The manufacturing side of the economy has been quite weak. The most recent payrolls data was on the weaker side. We've added in an extra cut in our forecast for the Fed, but we still expect them to go only 25 basis points in September, November, December. We're not looking for a big cut at any point. We just don't think the economy really warrants that at the moment. So yes, I think that there would be a point where the Fed would consider it, but we are far from that at the moment.
Let's get down to brass tacks then. I mean, we've had a moment of reflection, one could say, in the Mag 7 and on AI. We've been swooned into Russell and then slapped in the face. So where exactly how do I look at these markets? Do I see this as an opportunity to buy the dip? I kind of loathe that phrase. How do I look at this? I had somebody call me yesterday explaining dollar averaging to me. I said, it's okay, I know what it is. So give me your perspective in terms of what I do right now. If I'm fully invested, I'm long risk, I'm long equity, and I have a reasonable 60-40 portfolio.
I mean, look, actually, on that last point you make, 60-40 portfolios, they have done okay, I guess you could say, in this sell-off. Whereas in previous sell-offs, the last few years, they suffered because bonds fell at the same time as equities. This time, the bond market rallied and yields fell. Because people worried about growth rather than inflation. So actually for a 60-40 investor, I think that sort of 60-40 split makes quite a lot of sense at the moment. I do think there's a risk this correction continues. You get a more volatile August, etc. That's always tricky for investors. But if you've got a long-term hat on, if you can weather this for the next 6-12 months, then I think that actually equities give you reasonable returns, but not the returns that we've had up until sort of July for the previous year, where you had that 50% rise.
It's good to hear that the 60-40, finally 60-40, you know, behaving, bonds are behaving as the asset, as the haven asset as they should be. I look at the short end of the curve. I look at that really momentous turnaround yesterday, 34, 35 basis points on the short end of the curve. If you're smart right now, should I be buying, if not protection or put options, and the volume of those are high, they're expensive, perhaps relock and reload at the short end if the hedge of hedges is actually working as a hedge in the short end of the curve?
Yeah, I mean, there's lots of things that you can do here. I think that you could consider, I do feel the market is now pricing a greater risk of recession, a greater risk of declining rates than we would expect. We think the data has weakened ever so slightly, but really not very much. We think that the underlying jobs picture in the US is much better, and the Fed won't need to do any emergency cuts. And that therefore yields at the short end will stay a little bit higher, if not go pricing a little bit higher from here. So, you know, those short-term interest rates, that short end, the yield curve for investors may look a little bit interesting. But generally, I think this brings home this argument of you don't want all your eggs in one basket when you're investing. You want to diversify. You don't want everything in the Japan carry trade. You don't want everything in the Mag 7 or US tech. You want to have a diversity in your portfolio, including, and we've just discussed it, why 60-40 portfolios are also doing reasonably well at the moment, because bonds are buffering you against the sell-off in equities.
Sharon, you've just built the conversation for later on in the afternoon with the wealth manager, Sharon Bell of Goldman Sachs. It's not time to sort of do anything radical at the moment. There are other stories trending on the Bloomberg terminal this morning. Let me run you through them. The US safety investigators kick off 2 days of hearings today on Boeing's panel blowout accident. Executives for both Boeing and Spirit Aerosystems will testify. The hearing comes 7 months after the 737 MAX lost a fuselage panel during a flight. NVIDIA CEO Jensen Huang sold a record $323 million worth of shares in July, just ahead of the wider tech sell-off. Combined with the shares he unloaded in June, Huang has sold nearly $500 million worth of NVIDIA stock. The Korean chip company SK Hynix is set to receive $450 million in US grants and $500 million in loans to build a facility in Indiana. The award is the 15th agreement the US has made under the CHIPS Act. SK Hynix's customers include NVIDIA, Apple, and Microsoft. Coming up, Aramco is keeping the $31 billion dividend alive. This, as Saudi Arabia is pushing a multi-trillion-dollar economic makeover plan. More on the matters on Bloomberg. It is Bloomberg Brief. I'm Manaskrani in New York. The earnings are coming in this morning in the Middle East. We have Aramco maintaining its dividend of $31 billion. That's despite posting lower quarterly profit as Saudi Arabia faces a budget deficit in the coming years. Keeping the 2030 dream alive, Jumana Basechi keeps the dreams alive every day on Bloomberg Horizons in the Middle East and Africa. Jumana, when we look at these numbers from Aramco, what goes through my mind is the deal that they signed with the OPEC Plus members, which was to cap the production of Saudi at 9 million barrels. And that is coming home to roost in these numbers, I suspect.
Yes, absolutely. And yet, despite that, they had a decent quarter coming in line with analyst estimates. The stock is up 2.6% in reaction to these results. Net income down about 3% versus a year ago. So managing to keep up the net income despite some of those headwinds that you speak of. So yes, even though pricing is more favorable, oil prices are higher for the last quarter than where they were a year ago, oil production is an issue. As you rightly point out, Aramco are only pumping 9 million barrels a day versus a full capacity of $11 million. in reflection of those OPEC plus production cuts. So obviously that's going to weigh on the bottom line there. The second downward pressure is coming from refining margins, and that is not specific to Aramco. It's a reflection of the industry as a whole. Though the Aramco CEO said that he expects some of those headwinds to subside in the coming quarters. But the key takeaway here, Manus, is that even though we are seeing somewhat of a moderation in net income, they have maintained that dividends at $31 billion for the quarter, a key point for investors here.
And to that point, Joanna, the CEO on the tape just before we both came to air, the performance dividend is a permanent part of the calculation. They've had a second tranche of equity launched this year. Is that dividend payout to keep the new institutional holders on side? And a lot of them are here in the US.
Yeah, so let me point out one thing. First of all, relative to all of the other oil majors, Aramco pays the highest dividend yield. It's got a 7% dividend yield. And when we spoke about the allure of that secondary share offering that came out a month ago, foreigners were actually eager to get involved because of the very attractive dividend payout. And so for foreign ownership, it's important to continue paying that dividend, but even more so important for the Saudi government. Don't forget that the Saudi government still has a 97% stake in Aramco via the central government and PIF. And so for the Saudi government, it's become a very important source of funding. If you take that away, clearly it's going to weigh on the Saudi budget as well. One final point is dividend payout of $31 billion, free cash flow of $19 billion. This means that in coming quarters, you can expect that net cash position to continue dwindling further. So something to bear in mind. OK, certainly a hard balancing act. Stocks down 19%, underperforming some of the other majors. Joanna, thank you so much for the Aramco numbers. Let's pivot to the tech sector. Stocks might be bouncing back, but there is a sector which still has other issues to contend with. A US judge has ruled that Google illegally monopolized the search market through exclusive deals with Apple and others. Google plans to appeal that ruling. Tom McKenzie is tracking the story. I mean, this is history in the making. It's been a long time since the courts have won against big tech. How significant is this for Alphabet? Tom, good morning.
Yeah, you rightly touch on the timing there, Manus, because it's been about 2 decades. Here's the top line that stands out from this ruling, from the judge that you cited. And this is, and I'm quoting from this ruling, Google, I quote, is a monopolist and it has acted as one to maintain its monopoly. This is about, according to the ruling, these $29 billion or so annual payments that Google makes to the likes of Apple and Samsung to have this exclusive deal to ensure that their search engine is the default search engine. And what does that allow Google to do, according to these findings? It's allowed them to raise the prices of advertising without facing a competitive threat. Next steps, potentially, we're going to get a hearing in about a month's time. That's going to happen. Then they'll set the dates for another trial that will look at how Google rectifies this. That could mean splitting the search business, Google search business, from the likes of Chrome and Android, or it could mean that they are compelled to unwind these exclusive deals with the likes of Apple and Samsung. But as you say, this is significant. Google, Alphabet saying they will appeal this finding.
Timing is everything on the news release that you sold some of the stock of which you're a CEO. I'm talking about Jensen Huang. Selling nearly $500 million worth of stock in the last 2 months. You can look at this a couple of ways. You can't blame the guy for selling some stock. He's been fully invested there for a long time. Relative to, we've had a little bit of a shakedown. But there's other news flow there about the rollout of one of their new AI chips as well.
Yeah, which I think arguably is more significant. I mean, Jensen Huang, he set out this plan to sell down part of his holdings through this year up until around July, and he sold down about 500 million in the last few months. But that plan was set up in the early part of this year. So, yeah, big chunks of money have, of course, been unwound relative to the value of the stock. Not very much, but for Jensen Huang, he'll take that home. But in terms of the engineering challenges, I think arguably more important, this affects the Blackwell suite of chips that are meant to take over from the current one's Hopper. Analysts say, look, it comes down to the timing around how they fix these and how they ship these to customers. But the fundamentals, according to the analysts we've been speaking to, remain for this business. But some engineering challenges, speaking to the challenges around innovating in this space.
Tom, thank you very much. Stock down 10% there, as you can see. Tom McKenzie on the NVIDIA story and beyond. Context matters every day from New York on Bloomberg Brief. From front-page news for you from around the world. First up, Politico reports several U.S. personnel are injured in a suspected rocket attack at an airbase in Iraq. Now, the attack comes as Israel and the U.S. are deploying more forces to the area. The region has been on edge following the assassination of Hezbollah and Hamas leaders last week. Next up, the FT. Let's run with that. Rioters as young as 14 appeared in a UK court on Monday. Now, this is as the government promised that those involved in the recent violence and unrest will face, as they say, swift justice. The Prime Minister, Keir Starmer, vowed to ramp up criminal justice. And OpenAI President Greg Brockman says he is going on leave until the end of the year. Meantime, OpenAI co-founder John Schulman is leaving for rival AI startup Anthropic. And the move follows significant churn among the OpenAI management this year. Checking out on your tech trades this morning, this is how some of the Mag 7 are performing. You have a number of stories around. This is the performance over the year to date. You're still in the green on NVIDIA, up 124%. From our global headquarters in New York, I'm Manus Granny. Let's set your agenda on Bloomberg Brief. Global equities stabilized for now. Japan leads the rebound with the Nikkei jumping more than 10% after a tumultuous 24 hours. Still, investors question the scale of the carry trade unwind as Japan's top currency official and the BOJ say they're closely monitoring markets. And Aramco keeps its quarterly dividend at $31 billion despite the lower profit. Saudi Arabia faces a budget deficit. Good morning. You can all breathe easy. Japan managed to rally by over 10%, and so there was some kind of a recovery phase narrative to the U.S. equity session. We have come off our high since I came in at 3 a.m. You're looking at a global wipeout of $6.4 trillion globally over the past 3 weeks. Context matters. Are you looking at a 1987-style drawdown? Goldman Sachs say, look, it's hard to find a similar situation, but that's probably the most relevant context for you. There'll be no peace in this market until dollar-yen stabilizes. And to a certain extent, the dollar has rallied a little bit overnight by by four big figures. But that carry trade unwind, there's still another leg of it to go, according to Morgan Stanley, another $70 to $80 billion to go. Keep an eye on the very short end of the curve. We just had a conversation with Goldman Sachs, a 60-40 portfolio. Hello, it worked very well in this wipeout. The bonds acted as a haven, especially at the short end of the curve. Twos traded down to 364 yesterday, back to 399. We seem to have stepped back from the rabid calls and probabilities for an inter-Fed meeting cut. That seems to have dropped off. That frenzy seems to have dissipated. We did have a disinversion in the curve, 2s, 10s, and that really gave it a whiff of panic. Let me just show you what the Mag 7 are doing right now, or some of the components of the Mag 7, I should say to you. NVIDIA popping by 1.25%, despite Jensen Huang selling some stock on a delay. The delay on the AI advanced chip was news yesterday. We're bouncing this morning overall in tech. Microsoft up 0.7%, and Alphabet weathering the ruling against them at the moment on search engine. So we've talked about the carry trade, the size, the scale, and the torch that it lit under the the selling and the deleveraging that we saw. Paul Dobson is our executive editor for markets. And Paul, good to have you with me. So we have this moment of stability, one could say, but hardly floor. The question for markets is, to what extent is the carry trade fully responsible for yesterday's carnage following the growth scare on Friday?
Yeah, that is a really good question. I'm sure that it definitely played a pretty prominent role. One of the last cheap places to borrow in the world is slowly taking away the punch bowl, right, with the Bank of Japan raising interest rates. And that really has given people some cause for concern, caused a big retrenchment. And that's why we've seen the yen flying stronger against the dollar at long last after, so much depreciation. Like a big coiled spring, and hence that really big kind of repercussions and fear that it spread through the rest of markets. And I think as well as that, it's the additional thing is, the risk that realized volatility increasing in one asset causes people to retrench, but also means that they need to worry about their exposure in other asset classes. Hence, we have this kind of escalating kind of snowball effect that's been magnified. So we have calmer markets again today, but it feels like, funds that will be a little bit slower to react, that don't have that very fast pace of movement that we saw for traders able to get in and out over the last 24 hours, may still have work to do. And so, when you look at the sort of typical trading patterns around a turnaround Tuesday, as people like to call it, you have the big sell-off on Monday, you have the bounce on Tuesday, then we tend to have a slower kind of reset back into the more negative mindset that you saw at the start of the week. So I think that's what people will be worried about going from Tuesday into Wednesday.
Look, I doubt very much that risk parity, vol targeting, or trend following trades are fully unwind, not by any stretch. But that turnaround in the Japan market maybe takes the heat off the Fed in terms of how they communicate. We heard from Mary Daly, of course, still not ready to pull that trigger on rate cuts. What do you think the longer term implication or damage is here? Is it suddenly that the growth scare that we had in the United States of America on Friday is suddenly compounded? People are now really looking at China and Europe and looking at that trifecta and beginning to understand the globality of where we are at the moment.
It's so difficult to figure out, but confidence will definitely be burned in all of those popular markets after the sell-off that we've seen this week and over the past 3 weeks as well. And it takes time to rebuild that confidence once you've had a really dramatic and nasty looking sell-off. We've had a few setbacks this year, what people might term healthy corrections. This doesn't feel quite so healthy or quite so correct for that matter either. And I feel like, maybe people are going to be thinking twice about whether they want to come piling back in again. I mean, you could look at it the other way, and it seems like some people did today. If you've been wanting to buy Japanese stocks and get in on the rally, that you've missed out on it all the way through this year, then the reset right back to the start of the year in terms of pricing gave you a wonderful entry point. But on the other hand, are you going to be as fully committed, or are you going to be buying hedges? Are you going to be a little bit more cautious? Are you going to be more circumspect about what that outlook looks like and what the economic kind of impact from this market turbulence could be as well? Probably you're going to be a little bit more cautious going forwards.
Well, certainly yesterday relative to 1987, it's interesting. In 1987, the Japanese banks, we just saw Japanese banks yesterday lose the most since 1987 in one day. And it certainly was a very different feeling yesterday to that of 1987. Paul, thank you very much. Paul Dobson there. But the market is contextually different to 1987, to 2000, to 2008. Keith Lerner's lived through one or two of those market experiences, the Co-CIO and Chief Market Strategist at Truist. How did it feel to you yesterday? Because it felt as if there was real cross-asset panic and deleveraging. But I just wonder to what extent was there wholesale, ripcord pulling moments by asset managers and longer-term investment people, because it's not exactly a parlous economic state that we face in the United States of America. Good morning.
Yeah, well, very good morning to you. I will say yesterday did feel panicky. I mean, obviously, we had one of the biggest VIX spikes in history. It came off the highs. I could tell from just incoming calls anecdotally that there was some, certainly some nervousness. And you have to also remember, we've gone through a really serene environment, no 2% down days for one of the longest periods in history. And then all of a sudden you get a volatility shock. And, historically, we've looked at these volatility shocks. They don't tend to be over in a day because, as you have been discussing, there's a lot of people off sides. So even if you get a bounce in the market, there's this battle between fear and greed. And as you move, no one wants to take a loss. So as stocks bounce back up, you're going to see folks that look to sell into that. On the other side, people have been waiting for these pullbacks. They're going to be looking at that as well. So what tends to happen after these volatility shocks is they cluster. Volatility tends to cluster, wide swings both ways. And I think we have some time to repair some of the damage that we've seen over the last week or so.
What's the smart thing to do here? Because you see the short end of the yield curve. I was just chatting to Sharon Bell at Goldman Sachs. Short end of the yield curve bounces by 34, 35 basis points on twos. You see the bond market act as a solid hedge. yesterday. It perhaps had question marks around that in previous sell-offs. So what is the smart thing to do here? Is it to, that awful cliche, which is buy dips, or is it to pair your risk on any material bounces?
Yeah, well, I think in this case, I think timeframes really matter because, again, a repair process after you have the volatility shock tends to be measured in weeks and months. Our base case for our client base, which we're looking over at least the next 12 months, we still think the bull market deserves the benefit of the doubt. But coming into July, our main focus and our discussion with our clients is that the market had kind of moved ahead of itself, that sentiment was a bit stretched, and that in that environment, a little bit of bad news can go a long way. That said, corrections are not fun; they're always uncomfortable. But the emission price for being in equities, and historically, after strong first halves, the average correction you see at some points about 9%. So we're around 9%. I think this actually likely has somewhat further to go. So at this point, I would not be changing positions, drastically. One thing we just did late last week is we went long duration when the 10-year was around 460. Now we're below 4%. We're taking off that duration position. And also we're sticking with the U.S. and we're sticking with large caps as well. So those are things that are just on the margin that we've been changing.
We're just showing the markets as you're talking and as I'm now in the box. S&P now giving back most of its gains since I came in at 3 a.m., up 0.25%. You're looking across these equity indices at the moment, and they are just a little bit lighter on the feet. There you go. You can see the trajectory of the S&P still in the green, up 0.25%. Here's the debate, Keith. Real rates are 271 basis points. The market is probably saying that is too restrictive. Now the balancing act for the Fed is, how do you message not 25 basis points, but the reality that we're behind the curve? That seems to be the building consensus. Behind the curve, late to cut, and the necessity to do 50. How do you qualify to the market without panic that 50 basis points is a live option in September?
Well, I mean, I think it's a difficult position for the Fed. But I think if you just go by history, you are at a very restricted level when you look at the Fed funds adjusted for inflation. We're the highest since 2007. And, in their own dot plot, where we are with the unemployment rate is higher than where they thought we were going to end the year. Inflation, their core preferred measure on a year-over-year basis is around 2.5%. So even if we can debate what neutral rate is, but it's not 5% and it's not 4%, they're a long way away from what the Fed itself considers as neutral. So I think that in itself, along with some soft employment, suggests it's time to start moving. And why not start off with a 50 basis point move to move towards something easier, but you're still, even then, restrictive by historical measures.
The other, look, we're looking for canaries in coal mines. We're looking for red flags. I'm looking at credit yesterday, up over 7 basis points at 65.65, with the biggest climb since March 2023. I'd say that's a pretty natural reaction function, given the convulsions that you had in equities, given the moves that you had in FX, that credit would take a little bit of a pop. But how much attention do I need to pay to credit spreads and whether they remain relatively, and the important word here is relatively, constrained?
Now, I think it's very important. First of all, our message this entire year and also still now is stay with high quality. You are not being compensated for taking credit risk in the overall market. But more specific to your question, as a market indicator, I do think that's something else the Fed is going to be watching closely, because a functioning credit market is very important for the overall market. So spreads, for the first time this year, really started to widen the last week or so. If we start to see that move in a meaningful way, then I think the prospects of the Fed's coming in earlier could happen. But I do think that's extremely important for the overall markets, because you're not going to make a lot of headway in the equity market if you see credit spreads continue to blow out.
Well, as one person saying to me on the IB, there'll be no peace in markets until dollar-yen settles down and finds a level. I think they're praying rather than hopeful. Keith, thank you very much. Keith Lerner there of Truist. Context matters every day on Bloomberg. We bring it to you first. Bloomberg Brief. I'm Manus Cranny in New York. Quick snapshot of equities. That bounce that you had on the back of Asia bouncing by 10% on the Nikkei has given somewhat of the momentum back. Still, the view from Goldman Sachs is 60-40 portfolio acted pretty darn well. That's where you want to be. We've just had a conversation with Keith from Truist, and they are still Lerner over at Lerner. You want to be long, big tech, but this floor that was created earlier in the session is dissipating ever so slightly. The Russell is flat at the moment, and the Nasdaq, there you go, just dipping into the red. We'll keep an eye on those stocks as we go through the morning. And tech stocks, as we say, have been bouncing back. The sector, there you go, there's Alphabet up 0.3%, and that is despite a US judge ruling that Google illegally monopolized the search market through exclusive deals with Apple and others. Google plans to appeal the ruling. Let's get to Tom McKenzie. Tom, it was a ruling against Alphabet, but there's no breakup. I mean, you're a huge monopoly. You've squeezed everybody. You've used your financial clout, but there's no reparation.
Yeah, and Evercore, look, analysts at Evercore say this could stretch out into 2026 until we get a definitive resolution to this. Alphabet are appealing this federal ruling. But nonetheless, Manus, this is pretty seismic. It's the most significant antitrust ruling in favor of the Department of Justice. It's their biggest case in 2 decades, the biggest one of this century. So on that level, this is significant. And what they're alleging and what they have found is that Google were using these $29 billion of payments every year, approximately, to the likes of Alphabet, to the likes of Apple, I should say, and Samsung, these exclusive deals to have their search engine become the default. That allowed them to ramp up pricing around advertising, essentially with no competitive threat. In terms of those outcomes then, and I've outlined the potential time frame that Evercore are outlining for us or describing, what you could see, ultimately, you could see the judge coming down on a breakup, maybe spinning off, maybe selling off some of these businesses, maybe splitting up Google search from the likes of Android and Chrome. Or Alphabet could be compelled to unwind some of these competitive or these exclusive deals that they have signed up and let up with the likes of Apple and Samsung. So those questions still need to be answered. Top line is, this is significant. There's also potential ramifications as well for the antitrust probes that the DOJ are looking at when it comes to other big players in the tech space like Meta, like Amazon, and like Apple as well. This has set a precedent that can be used to inform some of that investigation, some of those probes into other big players within the space.
Yeah, I think the Attorney General, this is a victory against Google and a historic win for the American people. Now we just got to see whether we get a little bit more free choice. Talk to me about NVIDIA. I mean, there's 2 sides to this story. One, there's timing is everything. Jensen Huang selling $500 million worth of stock. I think maybe the more important one, as you and I have discussed, is the potential delay in one of their AI chips. Just how much of a headwind would that AI chip delay be?
Yeah, so I was going through the analyst reactions to this. Some have said it's going to affect them de minimis. Others have described it as being a blip, maybe a wrinkle in the road for NVIDIA. So their current set of chips are called Hopper. They're moving to Blackwell, and that's where the focus of this story is. It's on that new variation of these AI accelerator GPUs called Blackwell that they were hoping to ship, and say they're still on course to ship those towards the second half of this year. But we know now through this reporting that they've faced engineering challenges to 2 of those Blackwell chips. Other analysts saying, look, it's going to come down to how quickly they fix and then ship these chips. But the demand remains for these AI accelerators, and they still don't have enough supply to meet that demand.
OK, Tom, thank you very much. Tom McKenzie there with the very latest on the tech stories. Let's turn to Washington. The Vice President Harris has officially become the Democratic nominee for president in a virtual roll call vote. That happened on Monday. Joining me now is Zach Cohen of Bloomberg Government. So they've tidied up some of the potential challenges to the vice president running on the ticket for the Democratic Party. Now it's going to come down to, this is the fill or kill, the crunch day on her choice for vice president. It's all about somebody from the swing states, Zach. So how close is Shapiro? Is that the name that the runners and riders will come down on?
Really, the question right now is who does Kamala Harris pick as her running mate? Obviously, a job she's very familiar with after being President Joe Biden's running mate and then vice president for the last 4 years. The apparent front runners at this point are 2 swing state governors, Josh Shapiro of Pennsylvania and Tim Walz of Minnesota. Harris is supposed to start a barnstorming tour of the United States starting in Philadelphia tonight with her running mate. And she has interviewed not just Shapiro and Walz, but also Arizona Senator Mark Kelly in the last couple of days, as well as speaking to some other candidates, our colleagues are told. And so the vice president has a pretty marginal effect on the overall outcome of any presidential election, but can make a really critical difference, especially if Harris is hoping to balance the ticket with a perceived moderate, somebody with more appeal to maybe more rural, more independent swing voters. And so this is an important decision, if not the most important decision that Harris has had to make in the last 2 or 3 weeks as the presumptive nominee and now the nominee for president of the United States for Democrats.
And just looking at Pennsylvania, in 2020, Biden defeated Trump in Pennsylvania by 80,555 votes. That's a margin of just 1%. So that just gives you a sense of how closely balanced some of these swing seats are. Do we know to what extent that they have moved with the Harris campaign?
And Pennsylvania really is the cornerstone of the entire election, not just the presidential race. Its electoral votes are certainly a sizable prize for any either Democrat or Republican that takes that state. But there's a competitive Senate race there in November, as well as a couple of really competitive House races. So Pennsylvania really is a key prize, maybe part of the reason why Shapiro remains at the top of the list, somebody who can appeal to not just base voters in places like Philadelphia and Pittsburgh, where Democrats really need to juice turnout, but also able to appeal to outlying parts of the state. Back in 2022, he was able to easily dispatch his Republican challenger, who was seen as a very Trump-friendly election denier who had argued for overthrowing the 2020 election. So certainly somebody who could prosecute the case against Trump and put 2 former law enforcement officials, both Harris and Shapiro were former state attorneys general. And that could be quite the contrast to Donald Trump, as he is now a convicted felon running for the presidency for the Republican side.
Zach, let's see what the name finally drops today, is what we expect. Zach Cohen there of Bloomberg Government coming up on the show, setting you up for the trading day ahead. More volatility to come. Context matters every morning, live from New York on Bloomberg Brief. Bloomberg Brief, I'm Manny Scranny in New York. A look ahead today. This is what we got before the bell. Caterpillar and Uber report their earnings. So anything on the Uber and the consumer side is going to be certainly interesting by the markets. And then after the close, we'll hear from Airbnb and Rivian, plus the Democratic presidential nominee Kamala Harris kicks off a tour of 7 battleground states with her running mate in Philadelphia at 5:30 p.m. Eastern time. So we'll find out who the running mate is. Some stocks which are moving ahead of the bell this morning. This is what we got for you. Palantir up 8.3%. They boosted their profit forecast on AI demand. You got it. CrowdStrike, Piper Sandler raising his recommendation to overweight from neutral. And then Dell Technologies on Monday cut sales workers in a team shuffle and a new AI focus. I'll leave you with a snapshot of equity markets. You had Volmageddon yesterday, the biggest one-day explosion, propulsion and volatility since 1990. We are in the green, but only by a sliver. I can tell you this, JP Morgan have done the analysis. Institutional stock buying yesterday of $14 billion. Retail, guess what? We're sellers.